Money is something everyone uses every day. It pays for food, it pays for shelter, shapes nearly every decision people make. But very few people ever stop to ask a simple question. Who actually controls money? Most people assume money simply exists. They earn it, they spend it, they save what they can. But the reality is far more complex, because money does not appear naturally. It's created, managed, and regulated. Behind every modern economy exists a powerful institution responsible for guiding the flow of money. These institutions influence how much money enters the system, how expensive borrowing becomes, how easily businesses and individuals can access credit. Their decisions ripple through the entire economy. A small adjustment in interest rates can change everything. Loans become cheaper or more expensive. Investments rise or slow down. Businesses expand or hesitate. Markets react instantly. But for ordinary people, these changes often appear mysterious. A mortgage suddenly becomes harder to afford. Credit becomes more expensive. Savings accounts earn slightly more, or slightly less. The cause usually traces back to a quiet decision made far away from everyday life. These decisions are not made randomly. They are carefully calculated. Officials study economic data, inflation levels, employment numbers, growth rates, financial stability. Their goal is often described as balance. Too much money in the system can create inflation. Too little money can slow the economy down. So they attempt to steer the economy between these two extremes. But controlling something as large and complex as a modern economy is never simple. Small changes can produce unexpected consequences. Lower interest rates can encourage borrowing and spending, but they can also inflate asset prices. Stocks rise, real estate values climb. Wealth grows quickly for those who already own assets. Meanwhile, higher interest rates can slow inflation. But they can also make life harder for people relying on loans. Businesses may cut back. Hiring may slow. Growth may weaken. Every decision creates winners and losers, even when the intention is stability, because the economy is not a machine with predictable outcomes. It is a vast network of millions of decisions happening simultaneously, and the institutions that guide money must constantly react to this complexity. Sometimes they succeed in stabilizing the system. Sometimes the system moves in ways no one fully expected, but one fact remains constant. The people responsible for managing money hold extraordinary influence, not through direct control of individuals, but through control of the environment in which financial decisions are made. Interest rates, liquidity, credit availability. These forces quietly shape the opportunities available across the entire economy. They influence whether businesses expand, whether investors take risks, whether households feel confident enough to spend. Most people will never meet the individuals making these decisions. They rarely appear in everyday life. Their work happens in meeting rooms, reports, policy statements, yet the consequences of those decisions reach everywhere, into housing markets, into job markets, into the value of money itself. The system depends on this invisible guidance. Without it, modern financial structures would struggle to function. But with that power comes enormous responsibility. Because when money moves, everything else moves with it. Entire economies shift direction. Opportunities expand or disappear, and the financial landscape quietly changes, often without most people ever realizing who set those changes in motion. Welcome to Econ Noir.